2 things you can do today that will compound over decades without needing to become a market genius. One is tax-smart saving in TFSA and RRSP style accounts. The other is letting money sit unused in the wrong place for years. Today we unpack RRSP versus TFSA and give you a straight plan to decide which one to use first. These tools aren't enemies. They're 2 different ways to grow money, each with its own strengths. The trick is knowing when to use which and how to combine them so you don't trade certainty for a bit of tax relief now and pay later with interest. First, what they are. An RRSP is a tax-deferred account for retirement. You tell Canada Revenue Agency you'll save now, and your contribution lowers your taxable income this year. A TFSA is a tax-free savings account. Contributions don't reduce your taxes now, but the money you earn inside grows tax-free and withdrawals don't get taxed. In plain words, RRSP gives you a tax break today. TFSA gives you tax freedom tomorrow. The choice isn't about one good and one bad. It's about when you want the tax benefit to show up and how flexible you need withdrawals to be. The first idea to plant in your plan is this. Use TFSA for flexibility and short to medium-term needs. Think of it as a money vault you can dip into without tax penalties. It's ideal for an emergency fund, vacations, or goals you want to hit within the next 5 years. The second idea is to use RRSP for income tax relief and long-term growth. If you expect to be in a higher tax bracket in your working years than in retirement, RRSP makes sense. It lowers today's income tax and compounds money over a long horizon, which can translate into a bigger nest egg. Step 1 toward a real plan is a simple tax bracket check. Look at your current income and estimate next year's income if things stay similar. If you expect to be in a higher tax bracket next year, RRSP contributions can save you more money today. Step 2 asks about time horizon and goals. If you're saving for a goal that's soon, within a few years, TFSA is usually better for that use. If you're saving for retirement and you have years to grow the investment, RRSP can be very powerful. Step 3 is about room and cash flow. Check your current TFSA room and your RRSP room, which you'll find in government statements or your online account. Remember, TFSA room accumulates every year you don't use it. RRSP room is tied to earned income and changes with your salary. If you've got limited cash this year, you can still contribute a smaller amount to either account and increase it later. Step 4 is the hybrid plan. Don't pick one and never revisit the other. A balanced approach often wins. A practical rule is to split around 30% to TFSA and 70% to RRSP when you're in a moderate tax bracket and you don't know the exact future. If you're in a low current tax bracket or you're saving for near-term goals, you might tilt the other way. The key is to set a plan and adjust it every year. Scenario 1. You're a young professional in a lower tax bracket, maybe early 20s or early 30s. Your long horizon means lots of compounding time. In this case, prioritize TFSA for flexible withdrawals and a backup emergency fund. Then contribute to RRSP when you want a tax deduction and you're comfortable locking in retirement savings. Scenario 2. You're in a higher tax bracket now and you expect to be in a lower bracket in retirement, perhaps because you'll downsize income or rely on a pension. Here, RRSP becomes attractive. You save taxes today and let the money grow, then balance with TFSA to give yourself tax-free withdrawal options later. Scenario 3. You're near retirement, with some pension income and a mix of savings. The order often becomes RRSP to maximize the pension integration and to smooth income in retirement, plus TFSA for withdrawals that won't affect government benefits or tax credits. The blend protects you from a big tax hit in any one year. A common special case is when you have a company pension. If the pension covers most of your needs, you might rely on TFSA for the big goals and preserve RRSP space for a later time when you might need to bridge a lower pension period or a larger one-off expense. The main idea: don't let a single account dictate every decision. Use both where it helps the most. Think about withdrawals as a separate strategy. RRSP withdrawals are taxed as regular income, so you want them to fit into your retirement tax plan. TFSA withdrawals are tax-free, which makes them useful for budget stability in retirement or to cover big expenses without pushing your income into a higher tax bracket. A practical approach is to err on the side of TFSA for flexible, tax-free access and use RRSP for the income tax relief you'll need in your working years. Investing inside these accounts matters too. In a TFSA, you might choose growth-focused investments because the gains compound tax-free. In an RRSP, you can take a similar approach, but remember that withdrawals will be taxed as income, which can be a factor in choosing when to sell or rebalance. The rule of thumb: keep a simple core strategy, low-cost index funds, or a diversified mix, and let the tax rules guide where you hold them. A few big mistakes to avoid: don't open both accounts and then forget to use them. Don't assume the best choice is the same every year. Your life, your income, and your goals change, so your plan should adapt. Don't ignore contribution room. Small monthly contributions beat big gaps, and they keep you out of the trap of thinking a lump sum is the only way to win. Here's a practical, repeatable action plan you can use this year. Step 1, set a small monthly contribution target. Let's say 5% of your take-home pay to start, split between TFSA and RRSP based on your current tax picture. Step 2, automate those deposits. When money moves automatically, you're less likely to skip it. Step 3, set a yearly check-in. Review your tax bracket, your goals, and your room. Adjust the split if your income changes. If you're unsure which account to prioritize today, here's a simple decision tree. If you need flexibility and you expect to need money soon, put more in TFSA. If you want a tax deduction now and you're planning for retirement with time to grow, put more in RRSP. If you're unsure, start with a balanced split and refine it after a year of real results. The best plan is the one you actually follow. A two-bucket mindset can help. Treat TFSA as your short to medium-term bucket and RRSP as your long-term bucket. You'll sleep better knowing you have tax-free access for surprises and tax-advantaged growth for the long run. You'll also avoid the trap of letting tax rules fight your money instead of helping it. A note on the numbers. In plain language, TFSA limits are set by year. Currently, the yearly amount has hovered around $7,000. RRSP room depends on your earnings and grows with you. It's common to see a few $1,000s added each year as you earn more. Check your own CRA statements so you know what you're working with. Meanwhile, pick investments that match your risk tolerance and time horizon rather than chasing hot picks. The most dependable growth tends to come from broad index funds and low-cost options. You can hold these in both TFSA and RRSP, but the tax impact changes how you decide to rebalance and when you cash out. Consistency beats perfection. A steady plan that you can repeat beats a perfect plan you abandon after a few months. Automate, review, and adjust. The goal isn't to pick the perfect balance today, it's to create a habit that keeps your money moving toward your goals. If you're determined to start now, here's a mini checklist you can use this week. Check your current income and estimate next year's to gauge your tax bracket. Review your TFSA and RRSP room on your government portal. Set a small automatic split that you can increase later. Pick a simple set of investments for both accounts. Schedule a 15-minute monthly or quarterly review to adjust. One final thought. RRSP and TFSA are not magic. They are mirrors. They reflect your plan for the life you want, not just your money in the bank. When you see them this way, choosing where to contribute becomes less about winning a tax game today and more about designing a future you won't regret. If you found this approach useful, take a moment to try it this week. Start with one small change and build from there. Your future self will thank you for the consistency and the clarity you practiced today. If you enjoyed this, please give it a like. If you want more practical money plans like this, hit subscribe and turn on notifications. I'd love to hear your thoughts or questions in the comments, so tell me which approach you're leaning toward and why.